So I'm going to introduce our two fellas here. So these are two of the partners at our firm. Darren Yoder, he's got about 20 plus years experience in dealership accounting. He actually started working at a dealership before going into public accounting. And just a little fun fact, he just became a grandfather for the first time, so I tend to call him Grandpa Yoder. And he actually spends his weekends making homemade applesauce and strawberry jam because of his Amish heritage. What? So, thank you, Darren, for being here.
Thank you.
Our next person is going to be Brandon Wilson. He became a partner at our firm this summer. He has been with HHM for about 10 years. 10-ish years, yeah. Right? And if he looks familiar, it is because in high school, he was in an NSYNC cover band that actually appeared on Good Morning America.
Oh, man.
I think you were Justin. Is that right?
Really? You're going to make me say who
it was?
I
Justin. JC?
It was JC. And
there
I can tell you I still got a pretty good spin move.
Yeah, we might do some dance moves. If it gets a little quiet around here, I might make him do some bye, bye, bye. So, all right, we're going to go ahead and kick things off this morning. Our agenda today, we're going to talk about how this will impact your business, how it will impact individuals, and like I said, the goal is really to make sure everyone stays awake. So I'm a big fan of David Letterman myself, so we're going to do this top 10 style, starting off with how it will impact businesses. So I'm here as your moderator. You fellas ready to get going?
Yes, ma'am.
Let's do it.
All right. So number one, corporate tax rates. Let's talk about it. What's changed?
Basically, on the C corporations, went from 35% top bracket down to 21% bracket, which is significant savings. I know a lot of you guys are probably pass-through entities, S-corps, or partnerships, but there are some opportunities to look at converting to a C-corp to take advantage of that 21% rate. And that is actually permanent as you can get, whereas the 20% deduction on the flow-through income is set to expire in 2025 or 26.
That's right.
So,
yeah, you want to look at it. For the most part, we get questions: should I convert to a C corp? And we've looked at it, and in most situations, it makes sense just to stay what you are. If you are, and for you guys, buy here, pay here, a lot of your capital stays inside the business. So at certain income levels, let's say you're an individual and you're making $1 million of taxable income a year, it may make sense if you're leaving that money inside the business to convert to the C corp, and then look at long term potentially converting later on when you want to get that cash out.
and it also depends on what your long-term goals are. If you want to expand, if you want to, pass business on to other people, depending on what your long-range goals are, it may make sense to make that conversion to the C corp.
All right, so we're going to continue the second part of that. It's going to be the alternative minimum tax, also known as AMT, not to be confused with ATM. A lot of us are using that this week. All right?
Yeah.
What changed?
And a lot of people don't even know what AMT is or alternative minimum tax is. And basically, it was a flat tax that was put in place to where if the IRS felt like you were getting too many deductions, they would be like, all right, time out. You got a flat tax. And so that was in play through 2017. Moving forward, that AMT tax is repealed for C corporations. So if you're a C corporation, you don't have to worry about AMT anymore. And this, where I've seen this come in most of the time on the buy here, pay here side is if you were leasing cars. A lot of times your federal depreciation that you're taking on those leased vehicles would be greater than what the alternative minimum tax depreciation would allow you. So you would get taxed on that.
Yeah, get hit with the AMT tax.
So it's going away. It's good news.
All right, we're going to move on over to the net operating losses. What's going on there?
You want that one?
I'll take that one. Old rules, you could carry your NOLs back 2 years and carry them forward 20 years. Tax reform, carry forward only, and you're limited to 80% of those NOLs. As you guys all know, this business can be cyclical. You can have some good years, some bad years. So this is going to affect you. If you had a really bad year and had some big losses, you'd be able to take those back, get some money back, free up some cash. This has eliminated that. You can only carry those forward. So anything else?
Yeah, that's probably one of the negatives so far. That's, to
For
me,
the tax reform.
don't really like that one.
Don't really like it. All right. We're going to move over to the bonus depreciation, or as kids are calling it these days, bonus depreciation. Brandon, I think that's you.
I get questions on this, especially here in Vegas. People seem to think it may have something to do with like a bonus payout or something, but and I guess it kind of is, really. So in the past, the old rules were on new property placed in service, you could take 50% of that cost and deduct it in year one. That is now increased to 100%, and they've expanded it to not only include just new property, but if it's new to you, meaning it's used property that you placed in service, you got it from somebody else that's unrelated to you, now you can go ahead and expense that 100%.
It's pretty
What
good.
else is on there? Let's
Pretty
see.
good.
Hang on. Yeah, and it does phase out over the next. They're gonna start phasing it down. Let's see, what year does that start phasing down? Next year, I guess.
Yeah, 20% a year.
20% a year until it's phased out in 2026.
And one thing on bonus depreciation that is different from Section 179, which we'll get to next, is bonus depreciation can create a loss for a company, whereas Section 179, you cannot use that to create a loss.
I want to talk a little bit more about this bonus
Yeah,
depreciation.
let's do
So if you're leasing cars, and these are operating leases, true tax operating leases, guess what? If you're not, we're going to talk more about this later, but if that inventory is not on a floor plan, you didn't use a floor plan to buy those cars, as soon as you get that lease in service, you can go ahead and write off 100% of that.
For tax.
That's right.
Tax purposes.
For tax purposes. This is important because we're going to talk more about this later on too, but there's some like-kind exchange rule changes that now you can only do like-kind exchanges on real property, whereas in the past, if you had a fleet of trucks or whatever, you could do a like-kind exchange, you trade those in, get another one, and not have to pick up any gain. You can't do that anymore. But this kind of allows you to offset those gains that you're going to have to pick up on the property that you're trading in. Now you can 100% bonus and expense the new property that you're placing in service.
And I have had a lot of questions about bonus depreciation versus Section 179, and it is a little bit complicated, but we'll get there later.
We'll
as
get
we
there,
said.
Dan. We'll get there. All right. But you did mention floor plan, so we're going to go over floor plan interest. Is that still a thing?
It is. They were trying to eliminate, well, not eliminate, but limit floor plan interest, and some of our, friends of the industry went to Congress, and they got it passed that we could still deduct floor plan interest 100%. But in order,
However.
they took a little something away from us when we did that, and that was the 100% bonus depreciation. But with the increased Section 179 limits, we feel most people are not going to lose out on the bonus depreciation part by keeping the floor plan interest 100% deductible.
Is there a better choice in that, or is it really just depend on your situation?
I don't think there's a choice on it. If you have floor planning
Yeah.
and floor plan interest, you're not allowed to use the 100% bonus depreciation.
We got a question in the
Got a
back.
question?
I'm curious, has there been any regs that have helped define what is floor plan interest versus other forms of debt?
If it's tied to the inventory, you're probably gonna have to say it's floor plan interest.
So like if it was a line of credit that was, I guess, collateralized by your inventory, you think that would meet the standard for that?
We think that would probably fall in there, but I don't know if there's guidance issued on that yet. One thing you could do is just tie it to your notes, possibly, to eliminate it being tied to the cars.
Yep.
Yeah. One thing to remember is a lot of this is still in development. A lot of stuff is changing too.
Still a lot of regs that will be issued years from now.
So I'm not sure about the NIADA. I know Ken's been involved with some of the House Ways and Means stuff and trying to get some clarity on stuff, and so has the NADA, and that's one of the things that they've asked for is help us understand what qualifies as floor plan,
All right.
because it is important.
It is important. Let's head over to the business interest deduction limitation. What is
Brandon, you want to take that one and talk about?
Sure, I get the hard ones. That's fine.
That's good. That's
That's
good.
an easy one.
Yeah, business interest. So he talked about floor plan. You get all that. So how does this business interest deduction apply to buy here, pay here dealers, okay? If you have the related finance company, I'm assuming most of you do, although I've met with some people yesterday and the day before that maybe didn't realize that was even an option. But besides the point, if you've got the related finance company, that's probably where most of your interest expense is going to be showing its head. So the IRS says, okay, as long as you have business interest income, then you can fully deduct up to that amount any interest expense that you have. So for the related finance company, you have installment notes, right? You get interest income off of those. We're all in the business to make money on those things, so inevitably your business interest income on those installment notes should be greater than the interest that you're paying a lender that's advancing on those notes. So I think we're okay on that part. Where we may run into issues is on the dealership side. If you have a line of credit or a working capital loan or something like that, where it's not tied to the inventory, it's not floor plan, that interest expense could be subject to these other limitations. So you're not really going to have any business interest income on the dealership side. So you're going to be worried about what our 30% of taxable income is on the dealership side. Now, those of you who've been doing this a while, you realize because of the discount and all of that, oftentimes the dealership is barely breaking even or showing losses, whereas the related finance company oftentimes is the one making all the money. So that's where some planning can come in handy if you've got some non-floor plan interest on your dealership side. Let's take a look at it and make sure that we're shifting or we're keeping enough income inside the dealership to make sure we don't get limited on this business interest deduction.
You're talking about planning. When's the best time to do this planning?
Planning.
Now.
Yeah.
All right.
Between now and the end of the year, you should be talking with your CPA and trying to plan for some of these things so that you can actually make some informed decisions before the end of the year.
All right.
So now we're on the Section 179.
It's your moment to shine, Darren.
That's right.
Loves this Section
anyway,
179.
Section 179 went from 500.
Darren, hang on. I thought I said no code sections, man.
Yeah, we're not talking.
Okay,
we're not talking
well,
on.
everyone knows Section 179.
All right,
That's the
okay.
only code section you'll hear.
Does everyone know Section 179? Do we have a lot of CPAs in the room? I'm going to need you to break it down a little more.
Basically, Section 179 allows you to write off up to $1 million in property that you place into service in 2018. The limit was $510,000 in 2017. So, you know, this is a big benefit to the small business owner, people that are purchasing, you know, equipment, fixed assets, lifts, anything like that. They also, in the Tax Reform Act, there's some other things that used to be 39-year property that can now be Section 179. HVAC systems, roofs, alarm systems, things that used to be depreciated over 39 years. You can write them all off in the first year, up to your taxable income. And so this really offsets floor plan dealers not being allowed to do the bonus depreciation. So, anything to add, Big B?
I think you got it, man. Good job.
All right, and again, make sure you grab one of our tax form cheat sheets. It's a lot of information, but we really tried to break it down as easy as we could. We're going to move into my favorite subject. That's going to be Saturday sales lunches. Love a good
I
meal.
don't miss many meals, so go ahead,
Yeah,
Brandon.
go on.
Okay. In the past, you guys would bring in lunch or whatever for your staff on Saturdays or even during the week. Doesn't have to be Saturday. And those meals that you brought in-house to keep people working, keep people selling cars, 100% deductible. That's changing.
Yeah.
Moving forward, that's going to kind of go down to 50%. It's going to match up to the other meals rules, where pretty much anything else that you buy from a meal standpoint is now 50% deductible. So that's kind of a bummer. One caveat to this: your Christmas parties, your company
Holiday,
events,
yeah, summer picnics, things like that, they're still 100% deductible.
Yeah. So have a lot of parties.
A lot of parties.
Have parties every Saturday.
Yes. What about like-kind exchanges?
You were talking about that earlier. Go ahead.
Sure, Darren.
Yeah, it's good.
Like-kind exchanges. Really, the biggest thing is you can only do real property now. In the past, you could do everything from goodwill to
Franchise?
vehicles.
Yeah.
And now it's literally subject to real property only. So
Yeah.
real
And I'm not
estate.
going to say the code section, but what a like-kind exchange would allow you to do, you could exchange a piece of property for another piece of property. Any gain on that property would not be taxed at that time. You would reduce your basis in the new property and pay the tax when you get rid of that property later on down the road. So just a little bit of background as to what a like-kind exchange is.
That's
think
good.
it's a
Actually,
it's a
we
well-known-
forget that we don't want you guys to be accountants, and we sometimes think that you just understand. So if you don't understand something, just raise your hand and say, I don't know what that is. So thank you for clarifying, Darren.
No problem.
All right, my second favorite category, entertaining clients. All right, so what does this mean? I love taking people to, I don't know, go to concerts, football games, golfing. What does that mean?
There's
What's
been a
changed?
lot of discussion about this. Entertaining clients, the concert tickets, basketball tickets, things like that are no longer deductible. But if you have meals in relation to that and they're business purpose meals, they're still 50% deductible. There's a lot of articles out there and confusion about how this has changed, but business meals are still 50% deductible as long as they have a business purpose, document them, and all that. If you do have a suite at a Grizzlies game or something like that, Adam, you want to
Memphis.
make sure that if there is food provided at that they would break that out line item by line item. The part of the box and the suite would not be deductible, but the food portion of that should be 50% deductible if it's a business purpose.
So I do get this question, though. Some of my clients are like, you know what? This to me it's a cost of doing business. I gotta send my vendors out, my customers. I gotta send them to games. Yeah, I'm marketing. This is advertising.
Yeah.
I mean, what do you think about moving that to advertising?
You can,
The answer is no. It's still not deductible. So we know what you're thinking. And maybe you just don't tell your CPA, but if the IRS finds it, it's going to be no.
Not
It's
so
going to be
good. Not so good.
non-deductible. Got a question on the front. What's that? Sporting events in general, it's not gonna happen. The meals part, if they buy meals while they're there, sure, absolutely.
All right,
50% deductible.
we're coming to the end of our top 10. What about the pass-through deduction?
This is the big part of the whole tax reform is the 20% qualified business income pass-through deduction. It's really, I think, the meat of the whole tax reform.
And so S corps,
S-corps, partnerships, sole proprietors.
most of you are probably set up as S corps for your buy here, pay here, dealership, and related finance company. That's where this is coming in to kind of equalize the decrease in tax rate for the C corps down to 21%.
And basically, on the tax cut on the C corps, there are some smaller C corps out there, but a big part of that benefit was for the big public companies, going from 35% to 21%. So they had to put something in there for us little guys as well. So that's where this came in.
Yeah, so the gist on this, just looking at it from the most basic calculation, is you take your S corp and you figure out what your taxable income is, and you take 20% of that, and you say, okay, there's my pass-through deduction. That's the basic level. Now, it's not that easy, and there's limitations based on your W-2 wages and your depreciable property that you have in place. And so by the time you go through all these calculations, you may or may not qualify. We believe most buy here, pay here dealers will qualify for the 20% deduction because you pay a ton of wages. You got people who sell cars for you, and it's great, and that's what we do. And so we think you're going to have enough wages to be able to maximize to that 20% deduction.
And it may be, if some of you guys are doing a lot of 1099 contractors selling your cars, you may want to look at putting them on payroll to be able to take that 20%.
You definitely want to
deduction.
evaluate where you're at the year end or before starting now, see where we're at on those limitations. We did get some guidance out in August. So you probably are thinking, well, maybe my related finance company doesn't have any W-2 wages. First off, you probably should have some employees over there just to kind of check the box on those things. Enough said on that part. And then you may also have a related real estate. You may rent your real estate, and you may not have any wages over there. Obviously, we've got the property limitation that we can use, but the guidance came out and said we can aggregate these as one trade or business. So we can use our wages from our dealership, and we can use our property from our real estate, and we can combine all those to figure out where our limitation is. And I still think we're going to end up where we can get the 20% deduction. That's our hope and our plan.
Now, we do have a couple of accountants on stage, so I wanted to go through a quick example calculation. Can you see it on your screen?
Yeah, he's going to
I've
change
got
it.
it pulled up here.
But basically, so the top individual rate now is 37%. And so without the 20% deduction, you pay $370,000.
There you go.
Pretty simple math. But with the 20% deduction, that gets your taxable income down to $800,000. That times the 37% comes up to $296,000. And basically, it gets your top rate down to 29.6% from 37%. As you can see, if my math is right, that's
Is it?
about $74,000 tax savings with the 20% pass-through deduction.
Pretty big.
This is a good thing. This is a good thing for everybody.
It's a good thing.
Now, and I'll just throw one more caveat out there. You go through you go through all the limitation calculations at the entity level, and then there's one more potential roadblock. It comes down to your personal taxable income in excess of your capital gains. Your qualified pass-through deduction cannot exceed 20% of your taxable income in excess of your capital gains. Mm-hmm. So that one may mess us up. We'll see what happens with it. And you also want to kind of look at, the last thing I'll say on pass-through, you want to look at this as well as your bonus depreciation rules and your 179. And we're just now, Monday is a tax deadline for all of you who haven't filed your personal tax returns for 17. They're due on Monday if
Just
you
a
extended.
Free tip for you.
So we're going to start, we've done some year-end tax planning already for 2018, but we're really going to start getting heavy in that after next week. And so it's going to be interesting to see if I take bonus depreciation or 179 and I eliminate all of my taxable income. That's great because I didn't pay any tax, but I'm also not going to get any qualified pass-through deduction. So the bonus depreciation and the 179, it's always going to be there. You're always going to be able to take depreciation expense on that car or that property or whatever it is. So it'll be interesting to see once we start putting the numbers to it. Does it make sense to maybe leave some taxable income instead of bonusing all this out and get our pass-through deduction? I don't know yet. I don't know. We'll see what happens with it.
Yeah, I'm going to see.
We'll have to put the numbers to it.
Real quick, I know I said I was going to keep it to a top 10, but this is just a miscellaneous item to discuss. The cash method. You want to go over that real quick? It's actually a picture of Brandon last night. He won $16, so it's a big deal. Big deal.
What? Oh, is that me? That's not me.
No, I'm just kidding.
Yeah, go ahead, Brian.
Okay, so here's the deal on this. And I get this question all the time. And so the cash method, yeah, it is available. But you know what? Probably not for you guys, okay? The inventory, you're still going to have to expense it as you sell the car. And you know what else you have? You have buy here, pay here installment contracts, okay? And it sounds like the IRS looks at those as a cash equivalent, basically. So you got to go ahead and pick that up as income, which is why you do the related finance company. There is some talks on, okay, well, what about if we could write down the value of those buy here, pay here contracts into what they're actually worth? Because we all know they're not worth the sell price on day one. And so we're still waiting. I know there's some people that are trying to push the House Ways and Means Committee to look at this and see what options we have. But as it stands, I wouldn't bet on cash method at this point.
All right, that's going to wrap it up for that top 10 on how it's going to affect your business. All right, so again, taking it back to David Letterman, we're gonna do the top 10 key issues for individuals. Starting off with, you're welcome, for the individual tax rates. Up, down, tell me, what's changed?
We touched on that a little bit earlier. The top rate went from 39.6% down to 37%, and all the other brackets dropped a little bit as well. So 2% doesn't sound like a lot, but people in those top brackets usually have some flow-through businesses. They're going to get that 20% deduction, drop that rate down to 29.6%. So it's pretty significant for a lot of people, especially you guys.
All right, personal exemptions and standard deduction.
Well, tax reform is eliminating the personal exemptions. Personal exemptions were phased out for a lot of high-income people anyway, so not much of a difference there. The big thing here is they almost doubled the standard deduction. Married filing joint is $24,000. So a lot of people, they're not going to have to give you their mortgage interest statement, find all their $25 Boy Scout contributions and things like that. Unless, large property taxes, which is capped on another slide, and mortgage interest, the average family may not even itemize anymore, and that lessens the complexity of their tax returns.
That's good, cool. All right, I'm sure we got some parents in the house. Let's talk about child tax credit, cutest little tax deductions.
Yeah, this is actually a good change because most of your tax credits in the past, once you got up above, what was it, like 180 or something, I forget, 160,000 of adjusted gross income, you would miss out on this tax credit. That has increased, so more people will qualify to take that credit. And they doubled the tax credit from $1,000 to $2,000. And that was kind of a trade-off for them saying, okay, yeah, you don't get to claim your dependent anymore for the personal exemption at $4,000. Now we'll just give you $2,000 tax credit, which you end up in about the same place.
Is a credit or an exemption better, Brandon?
Credit, definitely. It's
Dollar
cash.
for dollar reduces your tax,
Dollar for dollar.
whereas an exemption reduces your taxable income.
What about mother-in-law? What if you want to bring
Yeah,
her into your house?
she's worth $500.
She
If
doesn't
you
count.
put her in the back room and support her, you get a $500.
I hear laughter. You know what he's talking about, okay?
You get a
All right.
$500 credit for a non-child relative, qualifying dependent, mother-in-law.
I'm not moving my mother-in-law in for $500.
No,
bucks.
Not
It's
worth
not
it.
happening.
Not worth it.
Good credit though.
What about estate and gift tax? Is estate tax still a thing?
Yeah, it is, but the exemption amounts have doubled. So in the past, if you were single, you could exclude $5.4 million from your taxable estate. If you were married, it was double that, 10.8. And now the new rules are, if you're single and you're worth $11.2 million, that can pass on tax-free. If you're married, you can give away $22 million tax-free, 22.4. This does sunset, I guess, in 2026. If they don't make this permanent, it will go back to the 5.4 and 10.8 rules.
And one thing to mention on this, even though there may not be any estate tax due, we still feel it's benefit to do estate planning to see how you guys are going to pass that business on to the next generation or to maybe to some key employees. Even though you don't have the estate tax, you still need to plan on how you're going to pass that on to the next generation, some of your key employees, some of your sales managers,
Yeah,
whatever.
you work hard. You want to make sure
You don't want
it's
the
up to
kids
you.
fighting over it
No.
after
Then
you're
you
gone.
just pay the lawyers.
Or Aretha Franklin, she didn't have an estate plan, I don't think.
Oh, boy.
Got awkward, yeah. A lot of her money went away. Okay, what about, let's see. Oh, I went back. Yeah, we're still waiting.
You
We
can
talked about that.
still give away money. You can still give away $15,000 each year per person that you want to give it to, and there's no tax impact there.
Yeah, and I take cash, check, or casino chips outside.
Come on, Darren. Come on. All right, what about salt? Not sodium. We're talking about state and local tax.
State and local tax, they have limited that to $10,000 at the individual level. There's several states, high property tax states, are trying to do a workaround on that. It's looking to us like the IRS is not going to allow that. They were looking at trying to have people give a charitable contribution and then give them a tax credit for that same amount. The IRS is looking at that as, okay, you gave them something, you received something in value, and they're pretty much not going to allow that.
All right, miscellaneous itemized deductions. Tell me about them.
You want this one?
Yeah, I'll take this one. So they've eliminated any deductions for miscellaneous itemized deductions. These used to have to be over 2% of your AGI, and some of these are things like unreimbursed employee expenses. The big one is investment management fees, and then again, also those high tax prep fees. You would not be able to use these as itemized deductions. For a lot of people, the increased standard deduction, this may not play in, but someone with a pretty significant investment account that, you know, pays 1% of assets, that fee will no longer be deducted as itemized deduction.
All right, this one's kind of awkward. Alimony. Last time I was in Vegas, I was flying home, sitting next to a fella, asking him how he did. He said, yeah, I did a lot of gambling. I'm not exactly sure how I'm going to tell my wife that I lost this much money. Hopefully this does not put you in that category, but if it does, let's talk about the alimony because it will affect.
Yeah, I'll start off on this one. So in the past, if you paid the alimony, you excluded that. You showed that as a reduction of your taxable income. If you received it, if you're the person getting the money, then you're showing that as taxable income. In the past, this is to old rules, okay? The IRS kind of got smart on that, and they realized, you know what? The person paying this obviously is in a higher tax bracket.
Yeah.
And so they said, you know what? No more. You don't get to deduct it. Now let me go back and say, if you are already divorced, and you already have your agreements in place and you're paying it, nothing
apply.
changes.
Yeah.
Nothing changes. It's all the same rules.
But if you're thinking about it,
just make sure you're
We hope no
negotiating
one
with
is.
your attorney that I'm not going to be able to deduct these, so maybe we can somehow work something out.
yeah.
But just keep that in mind. If you're paying them, if you get a divorce in 18 or after, and you're paying alimony, you're still going to pay taxes if you made that money.
Yeah. Nothing wrong with couples counsel. Nothing wrong with it. All right. Affordable Care Act, the individual mandate. What does this mean for Obamacare?
Yeah, on the individual, they are removing the penalty, which is nice. Mostly affected, you know, I think lower income people that were maybe not working at a place that provided health care coverage. So I think overall this is a good thing.
And heading back to the AMT, alternative minimum tax. Fewer people will have to pay, right?
That's yours, Brandon.
I was going to say, man, of course. That's fine. I get all the hard ones. No problem.
It's the new kid. That's
I'm
why.
actually a little smarter than Darren and better looking, but
But not better looking.
okay.
All right, you two.
So
You
we
do
already
have more hair.
I do have more hair. So at the corporate level, we've already talked about it. Alternative minimum tax, it's going away. For individuals, it's not going away. You still got to think about it, but you don't really have to think about it because fewer people will be impacted by it. They've increased the exemption amounts, the thresholds. Used to be like 160,000. If you made more than that, then AMT was going to get you. Now you've got to make over $1 million if you're married before AMT could impact your tax return. So it's a good thing.
One other thing on that, a lot of, in the past, having a large state income tax deduction would kick you up into that AMT. Having that capped at 10,000 now kind of will offset that.
Yeah, you just pay more in federal tax anyway,
Yeah.
I guess.
All right, what about education, savings, plans, stay in school? What does this mean? What's changed here?
All right, so this is the 529 plans where you can put money in a brokerage account, grows tax deferred to pay for education. If you use it for tuition and fees, you don't pay any tax on gains. They made, in the tax reform, they said, okay, people can now use that money for elementary and secondary education if your children are going to a private school. you can use up to $10,000 per year for those qualified expenses. One nice thing about that is grandparents, they can put, I think they can do 5 years worth of funding of that, so they could put $50,000 in this account, and you could use that to pay for your kid's private school. Anything left over could grow for college.
That's right. Two things on that. Additionally, is some of the states will give you a tax credit or deduction.
Or deduction, correct.
And so, obviously, we talked about the SALT tax, state taxes paid limitation.
State and local tax.
So you want to try to get those down because you're not going to get to deduct them up beyond 10,000 anyway. So keep that in mind. And the other thing is, if you haven't looked at investments and what the value could be by placing those funds in an investment account. So if you just look at history, and this is not really taxes, it's more of an investment. Hey, think about this. If you took that 10 grand, you take 1 year's worth, let's take that 10 grand and put it in one of these qualified education plans. And let's say your investment advisor says, all right, let's just put this in a fund that matches the S&P index. If you look at the last 40 years, the S&P has grown, or you've averaged a return of about 9 to 10% every single year. So what that means is you put that 10 grand in today, it's going to double
Gonna grow.
in 7.5 years. In 7.5 years, that 10 grand is most likely going to be worth closer to 20 grand. So
Kind
it's
of
a
like
pretty
a
good
crock pot,
opportunity.
like set it and forget it.
Yeah.
You know what I mean?
Obviously,
It's gonna be
there's
great.
risk associated with that. So I have to throw that out there. But definitely, if you're not investing, even if it's not for qualified education, just for your long-term retirement, it's the greatest way to build wealth, in my opinion.
What about just some miscellaneous things? Like I said, I like to keep it to a top 10. So those were the 10 biggest ways it's going to impact individuals. But here's a couple more things we wanted to throw in as well.
Yeah, charitable contributions used to be limited to 50% of your AGI. You can go up to 60% of that. I'm not sure how many people give away half their income, but now you can give away 60% of it. And one thing that, talking about the increased standard deduction, some charities are concerned that if you're not getting any benefit for that contribution that you give them because you're not in the you're not itemizing anymore. There's some talk out there that some contributions to charities, churches, things like that may drop off because people aren't getting the tax benefit. Hopefully you're donating, because you believe in the organization, but some people do it for tax benefit. And if you're not getting that tax benefit because you're not itemizing, there could be some lower contributions going to some charitable organizations.
All right.
You want to talk about the seating rights?
Sure. In the past, if you bought, let's say, I'm a Tennessee Volunteers college football fan, and I want to buy. It's been a rough time, but yeah, it has been tough. But gotcha. If you made that donation to the school and you got the opportunity to buy a seat, you could take a portion of that you could deduct. That is going away.
Yeah, you can't do that anymore.
Can't do that anymore. The schools are trying to come up with different ways to fight that, but I haven't really seen anything that's enticing me to buy.
Yeah, roll tide.
They'll
All right.
probably try something like the high property tax states did to get around it. And then the other thing is on medical expenses, they drop that down to once they exceed 7.5% of your AGI, they are deductible, but that's only for 17 and 18. Then it goes back up to 10%. You have to have some significant medical expenses for that to kick in, but if you do, and it's helpful. So
it's only for a couple years, and then it's going back to the old way? Okay,
Yes.
cool.
My wife, she's a lot smarter than me and a lot of a better person than I am, and she tells me, so I've gone through this with her several times, and she says, look, that is a lot of information for them to take home. You got to give them one thing to take away. The takeaway today is, guys, there is a lot of changes that have happened, and you need to look at it. There are some good things here that we can take advantage of, but
Good
we've got to
opportunities.
do some planning. We've
Yeah.
got to do planning. Reach out to your CPA. You've got a couple months before the end of the year. reach out, sit down, figure out worst case scenario where you're at, and then also look at what opportunities you have to mitigate your taxes with these new changes. Tax planning, reach out to your CPA.
Tax planning.